Now, how can we avoid cash shortfalls? If there's a shortfall, then managers must arrange a way to cover the shortfall in the short term. They can arrange a bank overdraft. I mentioned that before. In the short to medium term, they can reduce expenses. Businesses are always looking at ways of minimising their expenses. They can try and increase income, the sales, try and reduce drawings by owners. Sometimes the owners take too much out of the business, or if it's in a really crucial stage, they may choose to decrease that drawings to a bare minimum. They can defer payment of assets, or they might even want to lease assets instead of purchasing them outright, which has a bigger impact on the cash flow in the short term. On the other side, how to deal with cash surpluses. The business must try and use cash for productive purpose. So, for example, they could invest cash or purchase some assets. A new asset could be purchased. Maybe even a business could be taken over, or we could pay back some loans. Or in another instance, we can take some money out for the owners and they can have an extra payment of drawings. When we look at cash flow, it's important to realise the difference versus profit. A business can make lots of profit, but it still experience cash flow problems, and there's a number of reasons for this. A business may have made plenty of sales and have a high level of credit sales, but if they don't get paid back straight away, all this money is out there and it isn't coming in, and you're not completing the cash flow cycle, which can have an impact upon your cash flow in the short term. You may also be purchasing some assets that's nothing to do with income or expenses of a business, right? So that is still drawing on the cash flow. You may be obligated, or in some instances choose to pay back loans quicker. That obviously takes cash out of the cash flow cycle. And the business can still be making lots of profit, but if you pay back too many loans or too much of your loan, it can have an impact upon the cash flow, and therefore you may not be able to fulfill your short-term obligations to your suppliers, for example. The level of drawings by owners, as I mentioned before, is another way of how cash can flow out of the business, and that should also be monitored. As I mentioned, cash flow management is an extremely important part of any business, and quite often businesses get into financial difficulties, where they have overextended themselves in some way. So here's some strategies to avoid overextension and to try and maximise cash flow. Use of leasing. Instead of buying equipment outright, like cars, furniture or buildings, we can choose to lease them, and pay a normal rental amount every month. The downside of that approach is that over the whole period of time, you're going to pay lease costs and interest costs. You should avoid over-dependence of finance and debt financing. As I said in another lesson, debt to equity should not exceed 100%. So it means that 50% of your assets should at least be financed by the owners. You should use forecasting tools and cash budgeting, so you know that you can predict any shortfalls that may occur. Really, this bit of advice doesn't sound like much, but quite a lot of businesses have gone by the wayside by taking two big steps. So if you expand too quickly, that usually means that you need to borrow heavily in order to do it. That means that if things go against you, or there's an economic shock, or interest rates themselves go up, interest rate payments, you're then stuck with it. It impacts upon your cash flow, and your whole strategy may come undone. Don't invest too much in stock. While high stock levels are good for customers and hence more sales, a lot of cash can be tied up in stock. A happy medium is required, especially in a smaller market like Launceston. And the biggest cost, staffing. Businesses usually incur the biggest cost in their staffing. Businesses find it more difficult to keep staff in declining economic conditions, and such need to keep staffing levels trim and perhaps outsource some of the jobs or duties, and also by substituting labour with machinery. Outsourcing means you get a certain task and get somebody outside of your business, whether it be a consultant, another service firm or whatever, to actually do that particular job for you. In terms of the machinery, in some instances we employ more technologically advanced machines, and quite commonly what that does, it takes a place of labour. So that's the end of our lesson. I hope that you've learned all about cash flow, its management, the elements of the cash flow cycle, the purposes and elements of the cash flow statements, the cash budgets and how they're used as a sales forecasting tool, the distinction between cash flow and profit, and examples of how to avoid overextension. Hopefully that's been useful. Thanks for listening.